Hi, I am Rashmi Chaudhary, and in this video we will discuss the statement of profit and loss. Let us recall some of the relevant accounting principles having a direct bearing in the information presented in the statement of profit and loss. First accounting principle is the accounting period. Summary of income and expenses in the statement of profit and loss is for a period of time, commonly referred to as financial year. Income and expenses pertaining to earlier or subsequent accounting period are not taken into consideration. The second accounting principle is money measurement. Revenue and expenses that can be expressed in terms of money only are shown in the statement of profit and loss. All transactions done in other currencies are translated into the reporting currency using the then prevailing exchange rate. Now, the most important principle in this regard is the accrual principle. This principle states income or the revenue is to be recorded when it is earned and expenses are recorded when incurred. Incoming and outgoing of cash is absolutely immaterial for calculating the income of the period. Only those transactions which have an effect on owner's equity are taken into consideration. Further, the revenues are recognized when goods are delivered or services are rendered and collection is reasonably assured. And as soon as revenue is recognized, all the cost which went about realizing that revenue forms the part of expenses, that is the expired cost. Now let's see how to calculate revenue that needs to be recognized in the statement of profit and loss during an accounting period. If you are having revenue received during the year, then we need to add revenue earned during the year but not received. Then add revenue received in earlier years but pertain to the current year. Subtract revenue received in advance in the current year, and then subtract revenue earned in the earlier years but received in the current year. Now, expenses to be recognized in the statement of profit and loss during an accounting period. Expenses paid during the year, we need to add expenses outstanding to this figure, that is incurred but not paid. Subtract the expenses that are paid in advance, that means paid but not incurred. Then again add expenses paid in earlier years but pertain to the current year, and then subtract expenses of earlier years. Now let me clarify the revenue earned through an example. ABC Real Estate Limited has two commercial properties which are given on rent. During the year 2017-18, it received rent of rupees 55 lakh in respect of these two properties. Amount of 4,50,000 towards rent was outstanding to be received as on 31st March 2017. The same was duly received in the year 2017-18. As on 31st March 2018, rent amounting to rupees 5 lakh is yet to be received. So the question is, how much should be recognized in this financial year, that is 2017-18? Revenue received during the year, the figure is known to you, that is 55 lakh rupees. Further, the revenue earned during the year but not received, that was for the month of March 2018, was 5 lakh rupees. So this needs to be added in the revenue received during the year, as this pertains to this current year only, that is 17-18. Now, a 4,50,000 figure that was for the month of March 2017, that is revenue earned in the earlier year but received in the current year. So cash is not important. Important is when the revenue was earned. So the revenue was earned in the financial year 16-17. So this needs to be subtracted. So after subtracting 4,50,000, revenue that needs to be recognized in the statement of profit and loss during 2017-18 is 55,50,000 rupees. Now one more principle, that is the matching principle, that is important when you are preparing the profit and loss statement. Income is matched against the expenses incurred to earn that income to a certain profit. Say for example, any inventory that is lying unsold at the end of the accounting period is excluded from the computation of cost of goods sold or COGS. As I've already talked about the relevant accounting principles, further let me add some qualitative characteristics that make accounting information useful. The first qualitative characteristic is understandability. Accounting information should be comprehensible by those willing to spend a reasonable amount of time studying it. Relevance is the second characteristic. By relevance, it is meant that accounting information should have capacity to affect decisions. Third is the reliability. Accounting information should be dependable to represent what it purports to represent. Fourth is comparability. Accounting information should be comparable across different companies. Now comes the next characteristics, that is consistency. Accounting information should be comparable across different time periods also within a company. Then the most important characteristics is materiality. Any information that is relevant for the user must be disclosed, but at the same time, irrelevant details can be avoided. The threshold over which an item could begin to affect decisions. Any item of expenditure which exceeds 1% of the revenue from operations or rupees 10 lakhs, whichever is higher, is required to be disclosed separately in the profit and loss statement. The next characteristics that is also important is conservatism. It is better to understate the profit rather than overstate. That is, when uncertainty exists, accounting information should present the least optimistic alternative. Thank you.